So this video is going to be quick overview on process, and I'm going to go over a specific example towards the end. So if you don't understand the process quite fully, watch the example, and that'll kind of go through exactly what I would do in specific conditions. So context is pretty straightforward. The language isn't flushed out here yet, but I'll go over essentially what I do. I build my context from a weekly and monthly structural perspective first. I use volume profile and I look for value and how that value migrates. And I specifically look for the low volume areas and the high volume areas in that picture. I start with the weekly to look there first, and then I go to the monthly to look for the composites over the whole course of what's going on. Once I get once I get into kind of like the 2 week mark till the end of a month, I can start using the current month as a look back. But usually the weeks kind of leading up to the end of a month develop the more immediate picture, and then the prior month develops the kind of stagnant prior structure picture. From there, I use the weekly and monthly VWAPs as confirmation in terms of value breakdowns and bearish and bullishness, and just use that as kind of an overlapping confluence with how I see price migrating structurally. And just a quick look at that. After all that's kind of put together, I finish up with a process document that is my narrative for the day. And what I do is I essentially create 3-4 ideas that I want to see price interact this very specific way at, and that will tell me that I have an entry in a queue to take a position. So what's that look like from there? The execution times. 8:20 to 12:30 is my general session. If I have any trading done in that period, no new trade can be done after 12:30. So I kind of want to be managing after 12:30 if possible. If for whatever reason I haven't put on a position since that particular window, I can still take one opportunity at the 12:30 to 3 mark, but I don't want to overtrade. So that's essentially how that's going to break down. The entry zones in terms of risk management, we'll talk about entry zones in a moment, but essentially if a win occurs in an entry zone, that zone is now void. So whatever I manage or whatever I get out of that is kind of it until a new one sets up, and that can't happen. If 2 losses occur, that zone is also void. So if I'm over trading a particular area of momentum, then that's void as well. So 3R DLL total for the day and a 2-lot max. Pretty straightforward. Now we're going to talk about what an entry zone is specifically. Price has to interact at a narrative level. So price has to be in one of these zones. And what I mean by interact is it has to go into those zones and reverse in the direction we want to see that reversal. What will happen then, just to give you a quick example here, what will happen is, let's say this was an entry zone right here, this value area high. Price accepts into it, comes up, and then pulls away from it. This is the 3-tick reversal that you see on the Renko, these 2 white bars. From that extreme, we get an entry zone. So now I can execute a short inside of this yellow box. Price then has to penetrate the box, have a completed auction occur, and then price has to move off that completed auction. So from the bid or the ask has to drop and leave that completed auction behind. Once I'm in that, I have main stops and things like that can occur. And we'll go over that specifically, but essentially they are 3 and 4 ticks with 2 lots from the extreme. And then management's pretty straightforward. A stop is moved to break even after 4 ticks of profit, whether it's 1 or 2 ticks in terms of scaling. What this essentially does is it keeps me out of the noise. If I get a good position that goes up and then comes back and tags that and then continues, that's just what happens. That's the breaks. If using 2 lots, the initial scale is set to 4 to 6 ticks. That's really short-term rhythm. It's not R value, and we'll look at that with more specific examples later. And the core target is fixed until the end. And that's pretty much my complete process back and forth. But if you don't really understand exactly what's going on there in terms of the execution, we'll look at a specific example here. So price interacts at area 1 early in the morning. It's a little bit before my session, so I don't really want to trade it, so I have no access to this, but I am tracking it. So no access to this in terms of time, and also there's no completed auction here, but we start to sell off. Then we come into zone 2 where we actually see the IPB on the weekly, and we see that initial reaction from that area, but I don't get any penetration back up into the entry zone. So once again, no access. I don't have any prep here, so there isn't a true trade, but we can look at this in terms of the perfect management and how that would have occurred in the session. So this is the initial reaction at the narrative level. Let's pretend like there was something here. This is that initial reaction. It sets up the entry zone. So this is the noise that we're willing to look for excess. Comes down, no completed auctions here, comes up, gives us a bunch of noise, comes down here, still no completed auction. Right here, we get that completed auction. Let me see if I can show you where that actually occurred. It is right here at the 25 and 0 number. So we have the entry at the yellow line, and there's 2 stops are placed on either side here. This is pretty extreme from outside of the entry zone. So if this actually would have broken down here, it would have been kind of a bad situation. This was kind of the last straw for this entry zone to actually work. Once we pull up 4 ticks, we pull our stops to break even, which is our Cayenne hurdle here. And also in this particular situation, it would have been our primary first target. So at that point, our 3-tick stop, which is our primary target, goes away at this level. And our stop now goes to break even as the market goes up. Once the market goes up, we establish our core position, which at this particular reason would have been VWAP during the intraday for the continuation, and the 1.5 on the weekly. So that would have been kind of our core. It also would have really good R value in terms of what we were risking. So it would have been like 6-7 R at that point, and a good win. That is the perfect example. If I had narrative level built here. Since I didn't have narrative level built here, this is a more real life example. We come up into zone 2, and zone 2 is right here at this value high. We see our initial sell-off, which sets up our entry criteria, and we come back up into it, and we get a second entry kind of pattern shown, which is good news for us. Once we penetrate into that, there was a completed auction right here at this reversal that eventually became negated, but I would have probably executed this position as it's shown here. I would have gotten in here. It would have missed my break-even area, come up, taken out my initial first like my first scale scalp position, let's call it that. Then it would have sold off again and hit that 4-tick target. So we would have lost this position in total, and we would have moved our stop to break even, and that would have put us down 0.5 R with a break-even stop. Not a bad situation to be involved in there. From there, it would have been left to the core, which would have been a POC target rate down in here. Would have ended up with a real nice winner based on that information. And that's a more real-life example of how that may have occurred and how I would have reduced risk in that situation on a position that didn't quite set up perfectly. This high also was not a completed auction, so this really was kind of the last trade that was allowed to be done in this area without it breaking and kind of running the opposite direction. So those are my specific examples of how I would have managed these 2 positions, and that's my general rundown of process as it stands right now. Yeah, nothing else.